Hello, everyone. It is nice to hear so many beeps by people joining in, but saving our time of all the other participants. Let us start by a brief introduction of who we are. So today we are 4 presenters. Myself from Lithuania, head of tax in Lithuania, Grant Thornton Vilnius office, and together from Lithuania with Inesa. Please present yourself as well.
Good afternoon, all. I hope that you can hear me. I am Inesa Vilkaitė from Lithuania, the head of payroll services, and I'm looking forward to this presentation and sharing the knowledge. Thank you.
Kristjan, please.
Yeah.
Mārtiņš.
Yeah, hello everyone. I'm Mārtiņš from Grant Thornton, Latvia, representing tax department, and I'm really happy to see so many participants today, and I hope you will have some very useful information. Thank you.
All right, thanks, Mārtiņš. And Kristjan?
Yeah, good afternoon. My name is Kristjan and I'm representing the Estonian tax service line, and greetings from Estonia for 2023 to all taxpayers.
Perfect. So let us begin, and I am putting back our slides sharing for this event, which is a traditional event. We are doing constantly for many years now, and special thanks to Estonian Chamber of Commerce, our long-term partner in this series of recurring yearly webinars on key tax changes. Big thanks as well to Swedish Chamber of Commerce in Lithuania, as well as in Latvia and in Estonia, yeah, right, and Finnish Lithuanian Chamber of Commerce, as well as to Norwegian Lithuanian Chamber of Commerce. We are glad that you joined this together, and taxes indeed are quite important part of commerce in our countries. So today we will try to present it as clear as possible, and not delving into each and every change, but presenting those that we estimate as being key changes, as the most important. And let us begin by a payroll cost comparison between our 3 Baltic states. And we try to build this table with the first line being net salary, and you will see 3 different scenarios of, let's say, a low qualification worker of 1,000 euro salary, say medium 2,000 net salary, and a highly skilled employee with 3,000 euro salary. And in 3 countries, we see that this gives different gross salaries, but maybe it is not much relevant to compare gross salaries. However, if we are looking at total employer's cost and ratio total cost to net salary, then we can, even though seeing that it is quite similar between 3 countries, in some cases it is more favorable. Let's say in Lithuania with 3,000 euro salary, whilst with 1,000 euro and 2,000 euro salary, it seems to be slightly less taxation in Estonia. And in Latvia, even though we see that taxation seems to be, let's say, highest, however, as note below the table indicates, there is a possibility in Latvia also to have an additional a relief per dependent or children that is being taken care of by that individual. And this actually can pretty much equalize things. So in terms of taxation, we would say that the tax burden on payroll cost is quite similar indeed in our three Baltic states. And some differences might result in individual cases of what particular tax reliefs can be applied to particular individuals. Let us move on then to Lithuania part, and I will start with some key changes from areas I work most with, and then Inesa, our payroll services colleague, will carry on with other aspects related with payroll. The first news item I wanted to share, and I believe it is the most important, is that in Lithuania, tax penalties are increasing from 1st May 2023. It is expected and commented as such by tax authorities that it will not act, let's say, to the past. It will not be applied to tax mistakes performed in the past, but only to cases, let's say, tax errors or some omissions or otherwise tax underpayments committed from 1st May 2023. And increase is quite a significant one because it increases twofold. It was prior to 1st May 2023. Penalties could range from 10 to 50%. And in most cases where taxpayer was cooperating with tax authorities, not trying to hide something, usually the tax penalty was around 10%. In some cases it was higher, it's 20%, but quite rarely maximum penalty was given to taxpayer. And now it will be 20% minimum. And in the list of, I'd say, aggravating circumstances justifying even higher than 20, there are such things as not being able to provide transfer pricing documentation on time to tax authorities. So the change is quite heavy. Accordingly, as we also have the public list of taxpayers not meeting minimum reliable taxpayer criteria, in case of even such small errors for big companies as euro 15,000 or penalties of 1,500, it is very recommended to add this initial level of control to companies and to perform tax reviews proactively without waiting for tax audit from tax authorities, from state tax inspectorate or from customs. Without, let's say, scaring too much, let's move on to new disclosure requirements for platforms and payment services providers starting 1st January 2023. The change is coming from EU directive called DATS 7, and it is part of, let's say, bigger context of more and more information sharing with the tax authorities. I will not delve into technical details, as I saw that colleague Kristjan from Estonia has a bit more detailed slides on that, and I will leave this pleasure to him to describe in more details what it is about. But the same is in Lithuania, Latvia, and Estonia, and throughout the European Union. We also witnessed quite heated debates in Parliament about 9% reduced value-added tax rates for catering, art, and sports activities. And the final version adopted by Parliament was that for restaurants, cafes, and catering establishments, 9% value-added tax rate was prolonged for full year 2023. So it is, let's say, extra time for those businesses to have this additional stimuli from the state. And on the other hand, for performance services by actors, singers, and musicians, conductors, dancers, as well as for visiting sports events, sports clubs, and similar, beneficiary 9% VAT rate was prolonged only for half year until 30 June 2023. Let's move on then to next item, which is also good news to businesses. Is a new VAT deduction possibility for electric cars purchased from 1st January 2023. And key conditions are that car value must be up to 50,000 euro, including value-added tax, and class of this electric car must be M1, light passenger car, and unfortunately, deduction does not cover hybrid cars, so the car must be fully electric. There are no conditions about the car being new or used. It is not required for car to be new, so can cover also used cars as well. We would like, however, to remind that according to the general VAT deduction rules, VAT deduction is only possible when this property is used for VAT taxable activities as well. So even though a company performs some business activities and purchases a car, electric car, it does not automatically mean that they have right to VAT deduction. There must be a link also with value added taxable activities as well. If a car will be used for private use as well, calculating income in kind, then it is not negating right to VAT deduction, and it should be still deductible if some business use is also for value-added taxable activities. From value-added tax field, it is very good also news for small businesses, and there were infringement cases against Lithuania by EU Commission, and our colleague Vilma was also several times writing in public about this big problem for small businesses, and now it was amended the provisions of the law on value-added tax, allowing not to be forced to register for value-added tax if related individuals, for example, husband and wife, spouses, own two businesses which each do not reach 45,000 euro VAT registration threshold, but they together would be reaching this threshold. So until now, in such cases, VAT registration was required by tax authorities, and it is quite a heavy burden for small businesses. But it will be no longer. It will be necessary, however, to demonstrate that the management of these entities are not the very same individuals, and that the economic activities are also not of the same nature. So, for example, it can be a bakery and a car repair service, for example. But if they would be like two bakeries, then this exemption would not be available, and they would have to register for value-added tax. There are some corporate income tax law news as well. This item about anti-hybrid entities, anti-avoidance rules, is not by itself new, because it was introduced already some time ago. But there was a constitutional court case which denied entry into force of this provision for it being adopted in a shorter time frame than 6 months. And according to constitutional court judgment in that case, the government should allow 6 months transition period. So it is nice to know that this period is being forced to be respected by the government, and that this state of law measure works in Lithuania. As prior to that, every year it was very stressful to all the accountants, especially that every new government was eager to adopt some new tax measures just before Christmas, for example, to make the year-end festivities harder for accountants. Anyhow, let's move on to our news item, and also starting from the year 2023, it was set by both laws on personal income tax and corporate income tax that remuneration received both by legal entities or by individuals for land and or any other property being taken for public needs during special procedure for that. Such income will no longer be subject to neither corporate income tax nor personal income tax. So it is definitely good news to those that will be receiving such remuneration for year 2023. Some more minor item is related with large-scale investment projects preferential regime, and it was required now by law that a company receiving this preferential regime and smaller taxation of revenue from intellectual property used should also be actually performing the research and development related activities that are creating intellectual property. So it is touching to a quite small number of taxpayers, but quite a logical step, let's say. Moving on to freelancers, there will be a bit more freedom to them to choose accounting principle when they are not obliged to apply the accrual accounting principle. They will be able to choose to apply either cash accounting principle, meaning based on when cash payment is received, or accrual principle, meaning about when the invoice is being issued, disregarding the moment of receipt of actual cash. So it gives a bit more flexibility to those individual freelancers. There are some Intrastat reporting changes also. It is a gradual process of increasing them. So you can see in the third column that Intrastat import reporting threshold from the EU rises quite significantly up to 500,000 euro, and let's say moving goods outside, let's say to the EU, is increasing to 300,000 euro. Statistical value provision duty is also increasing to 7 million and 10 million. And I saw in Latvia there are also some changes about that. My colleague Mārtiņš will mention those. Finally, I wanted to also very briefly mention that and there were quite many changes on the law on companies, among which the minimum authorized capital was reduced for limited liability companies. So it will become easier to start your own company. It will suffice only 1,000 euro of capital to begin with your company. And law on companies also allows the possibility for shareholders to participate remotely using electronic means. There are some other changes as well, and if necessary, our legal colleagues can help with this area as well. Among some other, let's say, more minor changes, it is, as always, some excise duties increasing. We are not listing all of them, but a link will be in the slides that will be circulated to you, as well as the recording after this webinar. You can see as well that smart cash registers project called EEK was postponed until 1st March due to some technical issues at both taxpayers and apparently tax authorities side. So it allows a bit more space to breathe for businesses to implement that. And the third item from this section is that as a general movement of sustainability, tax for environmental pollution is also, say, increasing and expanding in scope also to pollution from organic solvents using equipment that must be registered. So it will be covering that in year 2023. And logically, landfill waste disposal is also increasing quite heavily, 5 times from 10 to 50 euro per ton. But here I will stop my monologue and before passing on to Inesa about minimum salary changes, I just wanted to also mention that you are invited to raise questions in the chat section of this event, and by the end we will try to address your questions as well. So Inesa, please.
Thank you, Vykintas. So I'm hoping to make this presentation quite short and sweet, as we don't have many payroll-related changes as of 2023. Anyone who's been working with payroll at least for some time knows that each year, at the start of the year, we have the minimum salary changes as well as some tax-related adjustments. So this year, the minimum salary wage for the full working time for the full month has been raised to 840 euros, which is approximately 66 euros net to the employee. Minimum hourly wage has also been updated to 5.14 euros. Now it may seem that we only have these small adjustments, but as accountants and as tax specialists, we need to keep in account at least 4 things. So first one is if you have any employees that are receiving a salary lower than the new monthly minimum wage, these employees have to have their labor contracts amended accordingly. Please keep in mind that if the employee is not working full-time, this wage for his working time should be approximate to the monthly salary. The second thing that is important is if you have any employees for which you are paying additional social insurance payments. So for employees who are not working full-time, who are receiving a salary lower than 840 euros, keep in mind that the social insurance tax amount that you will have to pay will increase due to the new monthly salary having increased from 730 euros to 840 euros. The third thing is, of course, vacation payments. If the employees received a salary which is lower than the new minimum monthly wage for months of 2022, October, November, and December, their vacation payments for January, February, and March will have to be amended to fit and not be lower than the new minimum monthly wage. And lastly, what is very important is the daily allowances that the employees receive. If you have any employees that are going to business trips and receiving daily allowances, but the gross salary specified in their employment contracts is, for example, less than 1,386 euros, it means that a portion of the daily allowances the employee will be paid has to be taxed. So don't forget about that. It's quite important. The second thing that is changing as of 2023 is the tax exemption amounts that are applicable to employees. Since the minimum monthly wage has been increased, we also had some tax exemptions adjustments for employees that are receiving a salary lower than the minimum salary. A fixed amount of tax exemption is applicable, which is 625 euros. If the employee is receiving a salary higher than the minimum monthly wage, but a salary higher than 1,926 euros, we have to calculate his tax exemption applicable according to the formula provided below. Same as last year, we have two formulas. So for employees receiving a higher salary than the 1,926 euros, we have another formula which has not changed from 2022. These changes in tax exemptions applicable means that employees that are receiving a gross salary lower than 1,926 euros have an increase in their net salary, just according to this change. Another applicable thing is, as I mentioned, the formula we had for 2022, it has stayed for 2023. And here you can see the calculations showing how the employee net salary increases just according to the new tax exemptions applicable. Similarly, as with tax exemption for employees with full working capacity, we also had updated information for employees who do not. So for employees who have a work capacity of 0 to 25%, the tax exemption has been increased from 870 euros to 1,005 euros. For persons who are working and have work capacity from 30% to 55%, the tax exemption has been increased from 810 euros to 935 euros. Differently from employees that have full work capacity, for these employees, the gross salary does not have an influence on the tax exemption applicable, and the same amount has to be applied each year. Now, lastly, we had a change in social insurance tax rates for employees participating in pension saving schemes. As you know, this has been applied as of 2019, and the progressive pension accumulation percentage has been increased each year. So this year is the last year that it is increased, at least as of now. And we see that it has increased from 2.7% to 3%, and the employee income is going to be decreased by 0.3%. Now, I know that a lot of people are searching for ways to cancel this. Unfortunately, there is no option for that now, but going forward, we hope that there will be some options on this. So, as I said, short and sweet. Thank you. Mārtiņš, word to you.
Thank you. Vykintas, can you switch to Latvian slide? So for introduction, this year there are very few tax changes in Latvia, and this is due to government elections that were held in fall of 2022. Therefore, we can expect that some changes may be in July 2023, but many more changes could be by the end of 2023. So let's start with the corporate income tax. In 2021 and 2022, there was a FinCap rule relief that FinCap rule was not applicable. But this rule relief is not enforced in 2023. Therefore, starting from 1st January, fin capitalization rules is applicable for all taxpayers. In short, fin capitalization rules apply to interest payments exceeding a specified amount. In Latvia, we have a debt to equity ratio of 4:1. And if there is a loan exceeding this debt to equity 4:1, then it could result in a corporate income tax in Latvia. However, there are potential actions to be taken to avoid this corporate income tax base. And one of this is to increase share capital. And when we are calculating fin capitalization rules, then the capital is being taken into account at the beginning of the year. So if we will increase the share capital in 2023, we can avoid the corporate income tax payment in 2024. So next option could be to capitalize the loan. This is also a solution that would work for 2024. As if we will capitalize the loan in 2023, then the equity will be again looked at the beginning of 2024. And this could help to avoid the corporate income tax in 2024. The third option could be to change the lender, transfer credit to financial institution, as Latvian corporate income tax law provides exemptions for loans from financial institutions and institutions comparable to financial institutions. So if a taxpayer has borrowed money from non-financial institution or company, the taxpayer can evaluate possibility to change the source of funding, and this could be a way how to avoid corporate income tax. And this could be also applicable for 2023. So let's move to the next slide. As Vykintas already told, then Kristjan will go in more details with the DAC 7. However, in few words about Latvia, also Latvia has implemented DAC 7 starting from 1st January 2023. In accordance with the DAC 7 regulation, platform operators will have to report sellers of goods and services to the tax authorities, and it applies for legal and also for natural persons. The platform operator will be obligated to collect the general information about the seller, which is name, company registration number, etc., as well as the bank account to which the remuneration is paid and the amount of remuneration paid to each seller from the platform. Additionally, operators will have to inform tax authorities on taxes which is withheld from the seller. the first report for DAX 7 in Latvia must be submitted by 31st January 2022. In Latvia, it will be done by electronic declaration system of tax authorities, and also tax authorities will be able to apply to impose a fine up to 40,000 euros if the platform operators will not comply with the reporting deadline or other regulations. So let's move on to the next slide. Then there is some changes in value-added tax and personal income tax. Regarding value-added tax, during the COVID pandemic, we had 0% VAT to supplies of COVID-19 vaccines and COVID-19 diagnostic medical devices, as well as the services related to vaccines and devices. But starting from 1st January 2023, the supply of vaccines and medical devices will be subject to reduced VAT rate of 12%. And for the services, the standard rate of 21% will be applicable. Regarding changes in personal income tax, again, the special tax regime for royalties has been extended until the 31st December 2023. And if a recipient of royalty will not be registered as performer of economic activity, then the payer of royalty will be obligated to withhold personal income tax from this remuneration. Then we can move on to the next slide, please. There is a changes also in electricity tax. So as of 1st January 2023, the electricity tax will not be applicable to electricity that is directly used to ensure the production of energy. So this is applicable to electricity generation plants producing electricity and cogeneration units producing both electricity and heat energy at the same time. However, this exemption is not applicable if electricity is utilized in the production of exclusively generates thermal energy, which is energy for heating. So, and let's move on to the next slide, which is my last slide. Those are some other changes. One of them is minimum wage, which is increased in 2023. So previous it was 500 euros, but starting from 1st January it is 620 euros. Then there is reporting thresholds for Intrastat, which has been increased, and also for the excess duty for cigarettes, tobacco products, and e-liquids is increased. Shortly, this is it. I'm giving word to Kristjan, and thank you.
Thank you, Mārtiņš. Please, Kristjan.
Yeah, thank you, Mārtiņš. Unlike maybe as an introduction before going over the rates, unlike Baltic neighbors, not many changes have taken effect in Estonia since January, nor probably also during all of 2023. And the main reason is the coalition that worked for a very short time now and the coming spring elections. There are no radical tax promises in election programs, at least I would say from a non-resident investor standpoint. And even if a new government were to agree on some tax reforms or minor changes, they could presumably not come into force before next year. So in addition to some minor changes, our taxpayers are also affected by some new EU directives, which we will talk about in a bit. And the following overview is made primarily for the benefit of non-resident investors. So there are some other changes in the rates, like increase of a fuel excise duties was postponed, fortunately. However, tobacco excise duty has increased this year, but this is probably not so relevant information to the Latvian and Lithuanian investors. And at the end, also, we will go over shortly the focus points of Estonian tax authority. So Vykintas, please, let's go to the first slide. So for the benefit of Latvian and Lithuanian listeners, we will start by going over the main tax rates by each tax type that are valid today. So firstly, about corporate tax. The standard rate is still the same, which is 20% if we compare that to the traditional tax systems like to Latvian. But it's calculated on the net distribution. So in that sense, if we calculate the corporate tax on the net profit distribution, then it has to be calculated as a gross-up rate, which is 20 to 80. It means 20% on the gross profit, 25% on the net distribution. So this is exactly the same as it is also in Latvia, which also has the same deferred taxation system as we have. But differently from Latvia, we do have some time already the reduced tax rate also. And since the efficiency factor of this reduced rate and its application often raises questions among non-residents, we will talk about that separately also later. Personal income tax is the same flat 20. We don't have yet progressive taxation in rates. However, we do have a kind of indirect progressive taxation because of a non-taxable income or tax-free income or basic exemption, as it often stated, which is up to 654 euros per month, and it works a bit. Its working principle a bit complex. It means that if a person's gross income exceeds 1,200 euros per month, then the rate of a tax-free income begins to decrease based on the linear formula, and it reaches actually zero at an annual, not to annual, but to a monthly income 2,100. So this is why there was, if you concentrated to the payroll tax comparison in the beginning, you noticed that while the tax basic exemption is quite high, but it applies efficiently only to the very lower income up to the 1,200 euros per month. And if you compare the 3,000 euro gross salary, it does not help at all. So we also have additionally the parents' additional tax-free income applies starting from the second child per year, and even more starting from third child. So let's move on. Yeah. Social tax rates. It's again a bit now different especially compared with Lithuanian principles, where most of the social security taxes relies on the employees through the withholding. In Estonia, the social security tax is fully the cost of employer. This is why there is no point to compare the gross salary between the Baltic states. In addition to the social security tax, 33%, we do have also the unemployment insurance premium. Part of this is employer's liability, and 1.6% is also withholding liability. And also the 2% is a voluntary. It's not mandatory, but voluntary contribution to the second pillar pension fund. So yeah, the minimum wage is also increased a bit, starting from 1st of January. It is now €725 per month. And about VAT, the new reduced rate, 5% introduced, not 1st of January actually, but already in the middle of last year, which applies for both physical media and electronic press publications instead of previous 9%. But the standard rate has been remained same very, very long time. It's a 20%. And the VAT registration threshold also many years already, €40,000. So let's move on. Yeah. So why we are talking about the reduced corporate tax rate? It's actually that in recent years the interest of foreign investors has increased regarding the different possibilities of taking the profit earned through the Estonian company out of Estonia. So because Estonian deferred taxation has helped to accumulate this profit, but sooner or later, for one reason or another, the profit must be taken out, and the foreign investors also always looking the most tax efficient ways. Sometimes they try to use often very aggressively the transfer pricing, which is quite risky because of a new TAC 6 automatic exchange of information on reportable cross-border arrangements, applicable for many years for now. So where the tax advisors, lawyers, or the management board members have to inform the tax authorities and have to conduct this hallmark test analysis, motive defense, so to speak, analysis on such transfer pricing and including different type of cross-border restructuring. So this is quite risky. Also, on temporary, the loans to the foreign related party, to the parent company, for instance, have been used. Even if it's at arm's length rate, you have to know that according to Estonian law, such loans, intragroup loans, are reportable, and up to the 4 years, if it bears arm's length interest, not so problematic. After that, it could be quite easily reclassified as a hidden profit distribution and taxed, not the interest income, but the full principal amount subject of corporate tax. So therefore, maybe the most, if you want to mitigate the risk, the most, maybe the optimal way, clearly not, but the most risk-free way is also to consider the actual formal profit distribution. And in case of a regular profit distribution, the reduced rate actually applies, which is the 14% instead of 20% if we compare the gross profit taxation. And in addition, if a recipient of a dividend is a private shareholder, doesn't matter is it Estonian tax resident or non-resident private shareholder, but 7% withholding tax rate applies also. So from the Estonian UBO's perspective, at the end, doesn't much matter. The effective rate is actually the same. So the question is, what is the impact of a reduced corporate rate to Latvian and Lithuanian investors? Well, No impact to Latvian investors in terms of effective rate. However, the cash flow effect to the Latvian companies shareholders, because if Estonian company's shareholder is directly the Latvian corporation, then there is no withholding according to the EU law. So there is only 40% against the 20%. So that is the cash flow benefit. However, otherwise, if a dividend is paid directly to the Latvian private shareholder, then although the Latvian applies the exemption on the Latvian taxation on the foreign dividends from Estonia, then would you have a 14% plus 7% withholding? So at the end, exactly the same result compared with the ordinary rate. However, there are actually 6% benefit to Lithuanian investors. Why? It's in my understanding, the Lithuania does not rely on the exemption method to avoid the double taxation. It uses the credit method, which basically means that if ordinary dividends shall be paid out and 20% from the gross profit will apply, then this dividend income is taxable also according to the Lithuanian domestic rules at 15% rate. And you cannot offset the Estonian 20% because this is the corporate tax. It's not covered by the dividends article of a tax treaty. However, if we now talking about the reduced rate, then yes, on the top of the corporate tax, there will be withholding 7%. So if you look purely the cash flow at the time of distribution, the net amount transferred is pretty much the same compared with a standard rate. However, this 7% can be later offsetted against the 15% Lithuanian individual income tax. So the withholding income tax is not the cost to the Lithuanian private shareholder. So that's a clear benefit at the end. And if a Lithuanian company should get the dividend first, then again, no withholding income tax. And at the UBO level, it should be exactly the same because that should be probably treated as a tax-exempted redistribution if a Lithuanian company pays out dividend from Estonian source. However, the Lithuanian private shareholder of a Lithuanian holding company itself should pay the 15%. So the results should be exactly the same, regardless whether the Lithuanian whether the Lithuanian UBO is having direct shareholder of Estonian company or through the Lithuanian holding entity. And you can see also the calculation because there are specific transition rules applicable. The overall logic is quite easy to remember. The 14% reduced rate is applicable for the 3 years average distributed profit. But if you haven't paid out any dividends because you wanted to enjoy the Estonian deferred taxation and now start to pay out the dividends first time, how it is here in example, then first year you can't actually apply the reduced rate at all. You just pay standard rate. However, next year, 23, in this example already, you can use 1/3 of dividends can be taxed with a reduced rate, 2/3 with a standard rate, and so on. And after 3 years, if a dividend amount will be again the same, you can fully enjoy the benefit of a reduced rate. So this is something to consider, especially from the non-resident investors' perspective.
Thank you, Kristjan. This is very valuable and very often being asked by Lithuanian companies how to get back profit from Estonia to Lithuania, and your detailed presentation is very helpful on that. Thanks.
You're welcome. Let's move on to the TAC 7. So TAC is the Directive of Administrative Cooperation. As you can see, we have many of them already, and this is the latest. And basically, it sets obligation for the digital platforms operators to report the income earned by sellers of goods and services using the platform, like Airbnb, Amazon, Bolt, Uber, Booking.com, Etsy, and etc. The problem, what the TAC 7 is actually trying to solve is the lack of information of identity of the sellers and service providers using platforms and how much income they actually earn. The digital platforms are kind of opaque to a certain extent and therefore playing kind of a role also in the shadow economy. And based on the authority's assessment, only like 20% of income is declared by the sellers through those platforms. So what could be the actual case? Let's take the Latvian or Lithuanian individual investor having purchased real estate in Estonia, for instance, not actually having the Estonian tax resident status, not actually living in Estonia. Using the Airbnb platform to rent it out as a kind of accommodation service, then right now there is no automatic exchange of information to the Estonian tax authorities. So Estonian tax authorities don't know anything about such income. Although according to the law, according to the place of real estate, which is registered in Estonia, Estonia should have a pre-right to tax such profit. And we don't know how much and if any this in this case the foreign investor is actually declaring and paying taxes in its home country as well. So the platform operators are according to the rules required to report the information of all EU and partner jurisdiction sellers, all other countries which are in agreement for exchange of the tax information. There are quite many of them. So the information of non-Estonian taxpayers are forwarded to these respective jurisdictions under this protocol. And the platform operators must collect the information by the end of December each year. First time by the end of December this year, and report it to the tax authorities by the end of January. Report it to its own home tax authority by the end of January next year. Automatic information exchange between tax authorities will take place by the end of February, first time next year. And then based off this information, tax authorities can make the risk analysis and assess the necessity of either the supervision or in theory also even for filing the personal income tax returns, as it could be, for instance, in Estonia. So what is very important and interesting to see, this is not, the next is not coming actually from a directive, which is reporting stated for the reporting purposes. The directive itself is not giving the legal ground for the taxation. So before this year, the Estonian tax authorities had a kind of didn't have very clear guidelines. Let's see if we have a private seller, either it's for whatever service. So maybe the Bolt, let's see, the Bolt or Wolt or whatever transportation mean type of service. And the seller is not the company, the seller is not registered entrepreneur. Right now, it's not so clear whether such payment is subject of social security tax. Because the platforms are treating this as their platforms. They are just mitigating this, and this is the passive income or income, at least, of private service provider. In Estonia, the Estonian service providers, individuals cannot actually declare nor pay the social security tax, which is actually quite high. And many of them so far even doesn't declare nor pay the income tax. But besides this, the income tax will be solved by the directive itself, because the tax authorities will get automatic information about such income, so they can check. But the social security tax, now the Estonian tax authorities have kind of compiled the guidelines on taxation on such income earned through the platforms. Active income, because that's the active income. Estonian tax authorities treating that very clearly now as active income earned, but is taxable with all payroll taxes. So, and they are putting the liability or giving the guidelines that the platform owner is required to report, not only to report, but also pay the payroll taxes. And the passive income, of course, I mean, rental income is only taxable with income tax. But the transportation services, which is not the passive income, by this definition, it's treated as active income. The platform owners itself has to not only to report, but now they have to withhold income tax and pay on the top of that the social security tax, because they can't even put this liability to the seller or a private seller, because they cannot declare nor pay the social security tax. So this is very, very interesting development, and so far the platforms are treated this a bit differently, but now the guidelines are quite clear, and it will be very interesting to see how all those platforms are actually now following those guidelines. But so far, yeah, it's been like a kind of Wild West, so to speak. As mentioned, the platform or website or app which allows the seller to be connected. This is the platform, and it's for the customers for the provision of sale of goods, rental of immovable property, provision of personal services like babysitting services, delivery services, online language courses, whatever, and of course rental of any mode of transport. And also the non-EU platforms with Estonian sellers or Latvian sellers or Lithuanian sellers are actually obligated to register at least in one of the EU member states for the reporting purposes. We don't have to do that in Estonia, Latvia, or Lithuania. We can do that in other country, but at least in one country, and collect such information from each member of states. And reportable information, I think Mārtiņš pretty much covered most of it. There is a name, of course, the identification number, payment account details, sums and payments made to the seller, address of a real estate, and number of days each property was rented out. And there are also penalties, of course. Non-compliance penalties up to 3,300 euro in Estonia, at least. And if a platform has not provided information after 2 reminders, the tax authority also has right to add a warning on the platform webpage, or even block access to the platform webpage for users. So there are actual consequences. So last one, which is quite, I would say, difficult and complex topic, and that's very, very recent news. This has been agreed by the end of December last year. It's from EU level. It's without going to details. It's final now. So that directive is final. This will be implemented to domestic income tax law in each country. It will not apply this year. We have to investigate this. There are quite complex and different consequences. Fortunately, not to all taxpayers, not to all corporations. And the background is many years ago from one specific OECD G20 initiative, and it's been dormant last few years, but surprisingly now EU has taken initiative on that, and at least in EU this will be implemented. So who is affected? The minimum tax applies to groups of companies, multinationals, which consolidated revenue exceeds 750 million. So this SME threshold, above SME threshold, and that's not only in 1 year, but in at least two of the last 4 years. And to apply the directive, at least one of the group entities must located in EU, which makes sense, of course. It's not applicable for shipping sector, pension, investment funds, government institutions, international organizations, nor non-profit organizations. There's also an exception. Because 60% of Estonian entities are owned by the foreign investors, so many of them at group level would exceed that number. However, if a local, let's take the Estonian subsidiary, are exempt from a minimum tax obligation if average revenue in the last 3 years in single jurisdiction is not more than 10 million euros and profit does not exceed 1 million euro a year. So, however, still, based on the current estimations, this will still affect almost up to the 200 companies in Estonia. Only very few headquarters registered in Estonia. Mainly, of course, it will affect the foreign headquarters, but this is not so easy because with Estonian local or Latvian Lithuanian subsidiaries which are not accepted, and part of those groups, which total revenue is more than 750 million, then still have to actually the calculation, reporting, and payments are not only done at the level of parent company, not in the headquarters, but actually also at local level. And this is quite complex calculation and compliance. So how this minimum tax then will be calculated? That's basically following you have to find the effective tax rate, so to speak. If the effective tax rate of the entities is in one jurisdiction is less than 15%, so-called top-up tax must be paid to bring the rate to 15. But the effective rate is very different from a nominal rate. We could say, well, Estonia has 20% rate, nominal rate. Lithuania has 15%, no problem. But even Lithuania, which has traditional taxation, actually always doesn't have to pay each year 15%. You have a lot of additional deductions.
Yes.
And additional benefits regarding of multiples of tax depreciation and so on. So if let's take an example. If an Estonian subsidiary has a profit 2 million euros, however, only half of this is distributed. Then the Estonian subsidiary's effective rate is actually 12.5%. It means that under the minimum tax rate principle, additional 2.5 is due. And if this is not, which have to be paid at the level of a headquarter. So the top-up tax payable is calculated based on the excess profit. But it has quite complex calculation logic. So let's take when does a minimum tax have to be declared and paid? The first minimum tax declaration must be filed 18 months after the end of financial year 24, according to the directive, and later next year is 15 months after the end of financial year. And there are certain exceptions for Estonia and Latvia or any other country which will have which has a deferred taxation, 4 years exception. It's not like an exception that we don't have to follow the directive. We still have to, local subsidiaries still have to calculate this, but we don't have to pay each year the profit and pay the tax on that to avoid the additional top-up tax at the level of headquarter. We don't have to pay. We can enjoy the deferred tax for 4 years, but you still have to be calculate each year this potential tax liability, and at least by the end of 4 years, you still have to pay out then this average and pay at least a 50% effective rate, or otherwise the headquarter just have to pay on the top of that. So you could think that what's the problem? Why the headquarters could not pay the top-up rate, no problem, and still enjoy the deferred taxation in Estonia. But it's not so simple, because sooner or later they still have to take out the dividends for the cash flow purposes and still pay the Estonian deferred or Latvian deferred corporate tax. And then it's a question, if they have each year pay the top-up rate at the headquarters tax return, how they will get back? No questions. So for the profitable subsidiaries, local subsidiaries of the big multinational groups, I'm not sure how easy it is fully enjoy this deferred taxation later. For all the rest of the taxpayers, it's not a problem at all. You don't have to worry. But in Estonia, based on unofficial information from the Minister of Finance, Estonia are not able to implement this. They can't do that to the domestic income tax law, to the current corporate tax legislation, because it will be a totally separate piece of law, because it's so long and complicated. And they are not able to do that because of election. They can't do that, start with that before the next year. It means it will be implemented actually 2025, but retrospectively as of 1st of January 24. So for this, Estonia has not asked delay. So to avoid any kind of confusions later between the group entities. So it will be interesting to see after the directive and the explanatory letter is now soon will be introduced. All the tax advisors really have to cooperate each other, and this is something we have to look at greater details within this year, and this is definitely something what will affect many of us, and this is something that our Nordic Baltic taxation group also will keep eye on and let you know, and we will definitely make additional webinar on that matter. And last but not least, we have no slides here, but just as a promise to outline few focus areas of the tax authorities in Estonia. The focus still remains on the case-by-case inspections. So That's mainly good thing. I mean, the Estonian tax authorities are not conducting the wide, long, time-consuming inspections as it was like many years ago. So they are coming and they have very specific focus area or case or field. And of course, input-weighted deduction on larger purchases. Very often we are checking the legal ground of registered tax-free rights. This is very Estonian specific and probably also Latvian specific thing. If you can make the kind of monetary or non-monetary contributions into equity, fixed equity, it means share capital or the voluntary reserve or the share premium, for instance. And then this is called the tax-free rights, which you have to declare. And later you can actually offset this. You can reduce the corporate tax payment on the certain payments from equity. If a company pays out, let's say, buys back their own shares from a Latvian Lithuanian shareholder or from minority shareholder, then if you have registered those tax-free rights and you have quite a peak of fixed equity, then you can actually offset that and you don't have to pay any corporate tax. Or liquidation, if you liquidate Estonian company, liquidation proceed, which can't be negative, at least usually often positive, either it's a cash or whatever other assets, which will be as a final act will be transferred to a liquidator as a shareholder, then that is also a corporate tax base. But again, you can actually reduce that by having those tax-free rights. But sometimes those non-monetary contributions are not evaluated and assessed correctly. So the tax authorities now very often are looking through this. Also, we are focusing on different type of restructuring schemes. Whatever, is it spin-off after the development project has been ended, of real estate development projects, whatever, due to the current recession or whatever the needs are for the restructuring, which formally, according to the commercial law and formally by the tax law, should be actually tax neutral. But sometimes still tax authorities, we are now much more aware about the different options and they may reclassify if a main goal or purpose was the tax benefit, then they can actually reclassify those one way or another way. So this is something we can't use so easily that you will just go to the notary and based on the commercial law, everything is correct. This has to be analyzed very properly. And of course, the transfer pricing documentation also, if there are larger related party transactions, either domestically or especially cross-border, we time to time asking transfer pricing documentation from the taxpayers. But that's all from my side. Thank you very much. And I give word back to Vykintas.
Thank you, Kristjan, for a very detailed presentation. Indeed, many things are quite important for Lithuanian companies as well. And it gives some flavor how complicated actually this international tax system gets. I wanted to thank you all for your presentations. And now if there would be any questions, we will be glad to ask. For the sake of clarity, it would be best if you could list the questions in chat field. Otherwise, feel also free to send us the questions after the event. Tomorrow we will share with you the slides and also link to the recording of this webinar. Ultimately, let's say, while waiting for any questions, if there will be, I just wanted to share with Kristjan that quite often misconception that we hear a lot from Lithuanian clients is that in Estonia there is no corporate income tax. And while hearing your detailed presentation, I am sure that no one who were in the audience today will still think that there is no corporate income tax in Estonia. Actually, it is quite a special regime, and our Estonian colleagues can help navigating that. All right. So I do not see any questions. Q&A. Okay. Yeah. Sorry. Q&A. Mm-hmm. Yes, we have one question about Lithuania value-added tax deduction for electric cars. And the question is whether it is valid only for companies or also individuals, if I understand it correctly. So for the sake of clarity, it is applicable to all the VAT payers that are performing VAT taxable activities, and it can be also individual who is performing a value-added taxable activity, for example, as a freelancer or as a director of a micro enterprise. By civil services provision to micro enterprise. So in that cases where individual is performing VAT taxable activity, then he can also claim VAT deduction from purchase of electric car as well. So theoretically, it is not limited to companies. Whilst in reality, I believe that in most cases it will be actually companies that will use this scheme. All right, and I indicated before that we are preparing a tax systems comparison, and it is already published in Estonian company website, grantthornton.ee. It lacks, however, Lithuanian part, which we plan to add in a couple of days. We were busy preparing this webinar slides, so to speak, but hope to have this Baltic tax system input in also coming days, and we'll be happy to share with you afterwards as well. So if there are no other questions, then I wish you a good evening to all of you. A big thanks again to our colleagues from Chambers of Commerce for helping us with this event organization and publishing. We hope that our insights were valuable to you. And please do not hesitate to contact us if you have some deeper questions. We will be happy to help you. Any word from Kristjan, Mārtiņš, Inesa for closing? How do you feel, guys?
Thank you, everyone, as well. Good evening. And yeah, as Vykintas said, please keep eye on our social media channels and the web pages. Any more relevant comparison or news are covered in our websites as well.
Thank you. Thank you for your attention, and have a lovely evening.
Thank you all. Thank you for participating.
All right then. Nice evening to everyone, and see you later in future events. Goodbye.
Bye.
Goodbye.
Bye.
Bye-bye.